Coming up today, stocks bounce back. Are we in an AI supercycle? The latest on robotics, the G7 to support rare earth prices, the latest print on inflation, a government shutdown looms, and could we see the S&P index hit 10,000 before popping? It's been a great week, guys. Let's go. And a pretty nice finish to the week there. Bit of bullish breadth across the board. Welcome back to the channel, everybody. I'm your host, Jared. And before I share with you a bunch of interesting things going on out there today, I just want to quickly say a huge thank you to everybody who's jumped on board my new ETF Portfolio Service. I've had a massive response showing that there's a real desire from you guys to follow real trading backed by real money using my global all-weather ETF investing strategy. I'm excited to start this new portfolio next week. And so if you're thinking of joining, now is the time, as I'm only offering a 40% discount during this launch. Click the link below this video to sign up today and get inside in time for the first monthly rebalance next Wednesday, the 1st of October. And stick with me because later on in this video, I'll show you how the ETF portfolio performed again today, along with some other ETFs showing up on my radar. But first, as usual, let's just take a look at the market and where we currently stand. Fear and Greed Index finishing right in the neutral zone, even though we're not all that far off all-time highs. S&P 500 Index 66.43, giving a nice bounce there today as inflation came in line as expected, helping to reverse that little pullback we got from Tuesday through Thursday. We still finished the week slightly lower here, very much in line with seasonality, and according to the yearly calendar, could be a little mixed next week before going into a usually bullish first week of October as we kick off Q4 Wednesday next week. And Q3 wasn't bad at all. That's when we typically get the volatility and correction, yet the market just seems to keep on grinding higher. But the ever-persistent topic across the market continues to be, are we in a bubble? And if so, when is it going to pop? In fact, we're nearing records. The amount of global fund managers saying that equity markets are overvalued, now at 58%, and that's actually higher than the late 90s. Many people knew back then the market was overvalued. It just surprised many how far it went before it actually popped. And we can see back in 07, that bear market caught a lot of people by surprise. Not many people were viewing the market as overvalued. And so the AI infrastructure debate is definitely heating up. We're getting some big numbers being thrown around. New blockbuster deals every other day. These mega cap tech companies trying to outdo each other with their spending. And this chart's a few months old. We've now actually got construction spending on data centers just overtaking construction spending on offices, as that's really come off since 2020. And ever since GPT was launched, it's just been up and to the right for data centers. But will this surge in AI spending pay off? The projections is that AI data center capacity should actually accelerate for the rest of the decade. And the only thing that's really going to stop that is if we do get a bear market or a recession. Otherwise, if the market allows it, these companies will just keep on spending big, which is causing some prominent hedge fund managers like David Einhorn question all this spending, cautioning today that the huge amount of spending on AI infrastructure may destroy vast amounts of capital. And he does have a point. A lot of these tech companies are spending huge amounts of their cash flows and more tapping the debt markets, going all in on the AI build out. But as usual, you can look at it in two different ways. Everyone's got an opinion on this AI boom, bubble, whatever you want to call it. One positive thing is it's bringing about much faster gains in productivity compared to prior major innovations like the internet, electricity, and the steam engine. In the amount of years from innovation to productivity growth, we're already seeing that with AI, and that very well could accelerate in the years ahead as well. But the market still could go vertical from here. I don't think we've quite reached the craziness from the dot-com bubble, even though some people say we're already there. I don't think so, because just like this article suggests, when looking at some key indicators like IPOs, we still haven't taken out the 2021 highs with listings yet. And you look at that move just in the NASDAQ index. The last 3 years of the 90s went up about 5x. Before having a monster crash, the index itself came off 85%, and something like 98% of small internet stocks went completely bankrupt and delisted. And just think about how crazy that is. Imagine 98% of AI stocks, all these hot small cap, going bankrupt in the next 2 years. No doubt that would cause a lot of pain for people, especially for investors that don't have well-defined exit strategies, who will ultimately end up getting left holding the bag. Others out there say we're in an AI supercycle, could last 20 years. Even the man up the top, Jensen Huang, Nvidia CEO, says OpenAI will be the next multi-trillion-dollar company after his recent partnership with them, helping to finance data centers. But that's the thing, we very well could be in an AI supercycle. No doubt it's here to stay. It's only going to grow. But investors said the same thing about the internet in the late 90s, and they were actually right. The internet was a super cycle for the next 20 years, had profound changes on business and society at large, but that didn't stop the NASDAQ from crashing over 80% in the early 2000s, even though big tech companies like Amazon were still growing their revenues. And so we're getting a lot of parallels between the late 90s and now, with this chart overlay here, comparing a potential AI bubble to the dot-com bubble, looking at the NASDAQ index, and the S&P 500 as well, now approaching half of its market cap in tech stocks. On a lot of measures, we're at record valuations. But again, like I've been saying for a while, that doesn't mean it's going to top out tomorrow. It could have further to go. And just comparing the forward PEs of the 10 largest tech stocks back then to now, they peaked out at 41 times in December 99. We're currently at about 31. And I think this chart is a month or two old. So we very well may be at about 33 or 34 now, meaning the NASDAQ or mega cap tech just has to go up another 30%. And then we're pretty much at the same valuations as when the prior NASDAQ bubble popped. So if we're not already there, we very well could be on a path there at some point in the next 6, 12, or 18 months, in my opinion, which would actually line up with the famous Benner cycle. An American farmer over 100 years ago created this chart, which has resulted in pretty remarkable accuracy in timing bottoms, tops, and panics. And this chart suggests next year, 2026, could be a year of good times, high prices, and the time to sell stocks and values of all kinds. But again, the world isn't just that simple. No doubt American valuation are literally at their top percentile, looking back in modern day markets. But much of the rest of the world, Japan, Europe, emerging markets, they're actually sitting around their long-term averages. And we've got a bunch of technical strength in those indices as well breaking out, actually doing better than the States this year. And on a more lighter note, since it's Friday, regardless of all this valuation talk, AI is bringing us some pretty cool stuff. My wife's been sending me these videos of an AI-generated cat podcast, which I thought I'd share with you guys. Check this out.
Didn't you get a new scratching post?
Yeah, a huge one, but I still use the sofa.
Which is pretty funny. A lot of the internet was built on cat videos back in the 90s. Now we're getting all these AI-generated cat videos. What will they think of next? But regardless of the market and when the next correction or bear market comes, they normally only last a year or two max. The more important thing, in my opinion, is staying invested. Just like if you were able to stay invested in the internet throughout the 2000s, you would have done well. Of course, that's all clear in hindsight, but I believe a similar thing could play out. Not only AI, but the next big thing, robotics. And something that caught my eye yesterday was a Trump admin launching investigations into imports of robotics, industrial machinery, and medical devices, as he's once again putting the squeeze on entire industries to reshore their production on American soil. We just saw that again with pharmaceutical, going to slap 100% tariff on any imported pharmaceutical product unless a company is going to build a pharmaceutical manufacturing plant in America. So they're looking at doing the same thing for robotics in order to put a tailwind behind domestic production. And as you guys know, one of my favorite robotic stocks I'm invested in, Richtech Robotics, getting right behind this initiative, coming out with a post today. We're investing heavily into creating large robotic data collection centers here in the USA, as they're based out of Vegas. They made some good points today that simulation tech requires massive amounts of data to run accurately. AI use in robotics is constrained by a lack of data. Going on to say, right now, there are very few robotic data centers in the US. In China, there are 10 plus centers with 100 to 200 robots each generating data at massive scale. America must catch up. They plan to build large robotic data centers on US soil, where fleets of robots will collect real-world data, not simulations. This data will strengthen not just Richtech, but the entire American robotics industry. Finishing by saying the future of robotics cannot be built on CGI or simulated data alone. It requires real American robots generating real American data. Richtech is investing to make sure the US leads in robotics for decades to come. And this comes on the back of a surge of retail investor interest in Richtech Robotics over the last month or so, with their shareholder meeting scheduled for early next week, along with them potentially unveiling a new humanoid product at the NVIDIA GTC conference on the 28th of October next month. And so Richtech is quickly becoming a cult stock, a retail favorite, which is not necessarily a bad thing, because many of these stocks have had a cult-like status for a few years now. Tesla, AMD, Rocket Lab, Palantir, Robinhood, and more recently Opendoor, all of which have done extremely well. And one thing that sticks out to me on this list of 25 cult stocks is Richtech is the only one with an M, 675 million market cap. The rest of them are all multi-billion dollar stocks, and some of them well into the billions, like these quantum stocks that barely have any revenue. And so there was a bit of a pullback in Richtech Robotics stock this week, as they just came out earlier in the week with a shelf registration registration that lets them raise different types of capital when needed, plus a new at-the-market stock program of up to $100 million they can tap gradually, basically allowing them to sell shares on the open market day by day and then report it at a later date, which gives them the flexibility to raise cash quickly without a big one-off discount. And so yes, selling shares adds dilution risk, but the way they've done it is a bit more surgical. And as an investor, I'm 100% on board with this. In fact, I told my options members to expect a secondary raising to take advantage of elevated prices. Now, I know a lot of short-term minded investors are like, oh no, they're doing a secondary. Why are they doing this? Are they trying to knock the stock over? The answer is no. It's kind of the whole point of the stock market to begin with. Private companies going public with a primary offering, raising capital, and then occasionally doing a secondary offering, tapping the market for capital to fund its growth and give it more runway, help to scale robot deployments, fund research and development, and strengthen the balance sheet as customer demand builds. And so to scale up, they need that capital to be able to do it. So yeah, it's a little short-term pain, but in the long run, it should help out a lot. And so retail investors getting behind a company makes it more likely to succeed. The higher the stock price, the more easier they can issue new shares and debt, strengthen their balance sheet, and help them execute on their ambitions, which if they're successful, we also enjoy the fruits of that as well. And that's why it helps to have an investor's mindset and follow the business more closely than the stock price, as so many investors become obsessed with the day-to-day movement and base all their decisions and feelings on that. And so like I've been saying, it's a very volatile stock. It's not going to be its last pullback. Just looking at the size of recent peak to trough dips in the stock price, it did a 73% correction back in March, another 41% back in June when I last bought the dip, and just last month in August it did a quick 39%, and just this week it's already done about 31% as well. However, as investors, if you can withstand the volatility, not just in Richtech but even the market as a whole, you can earn a premium for tolerating that volatility. You just got to be careful not chasing prices too much and buying after peaks, because like I said last week, we very well could get a pullback this week, which we have, and it could keep coming down and tag the 50-day VWAP, even dip below it. But that's not my main concern. Like I said, I'm more focused on the actual business and the progress we're seeing there. And overall, for a really small, speculative, volatile stock like Richtech, I think the market digested it pretty well. Sometimes when companies announce secondaries, the stock can get absolutely slammed. But at the end of the day, it just gives them more runway to execute on their vision. And I, as an investor, are going to stick with them for as long as I can. Just moving on, it was also interesting to see this week the G7 thinking about putting in some price floors on rare earths in order to counter China's dominance in the supply chain, as they currently control over 90% of the total global processing capacity. And so it's good to see Western governments outside of America also look to get behind this, helping it to make it one of the hottest sectors the last few months. Looking at the REMX ETF here, had another great week with some rare earth small caps like Idaho Strategic Resources, also having a great week, finishing higher again today. And I expect to see more positive headlines in the weeks and months ahead in this really important sector, which plays a key part in many future technologies. Robotics as well. Just moving on to a bit of the macro, looking at the latest inflation print, came in line as expected, with PCE coming in 2.7% year over year. Once again, we're just not seeing a big bump up from tariff. In fact, we've now got the 6-month annual rate change starting to downtrend for both goods and services PCE. So that's probably what helped the market pick up today, as we got a batch of strong economic data yesterday, bumping up yields, showing that the US economy is still holding up pretty good overall. Personal spending growing 0.6% month over month, which is no doubt prompting the Fed to kind of thread the needle here. Strong GDP, corporate earnings, consumer spending, but a weak labor market. But as usual, there's more to it than that. Big changes in immigration and the government dramatically slowing down their pace of hiring. And right now, it's a bit of a no country for young men. The unemployment rate for 16 to 24-year-olds is above 10%. No wonder so many are turning to the markets to try and make some money, as they're struggling to find a job and don't want to play the same game that their boomer parents have played, with many of them not seeing a path to prosperity, which no doubt is a difficult situation to properly address. Just moving on, the US government could very well shut down come Wednesday next week. Doesn't look like we're going to get a deal. Prediction markets have got it at a 71% chance and climbing that they will shut down next week, which sounds a lot more bad than it actually is. It's actually happened a few times in the past. And the S&P 500 largely ignores it. Looking at the returns the week prior, during, and afterwards, looks pretty much random, with maybe a little bit of a bump up coming out of it. But we don't typically see a big sell-off during a government shutdown. Moving on to a long-forgotten stock that isn't really talked much about these days. Electronic Arts, big video game maker, looks to be going private and potentially the largest leveraged buyout deal ever. Current market cap $42 billion. New owners likely have to pay around $50 billion to take it off the market, helping to send shares rocketing higher today, up almost 15%. And that also helped to bump up the Van Eyck video gaming and esports ETF, doing a lot better than in the market here today, as it's already been one of the best performing ETFs this year. And interesting to note that the majority of the fund is invested in Asian gaming stocks. In fact, 62% of the ETF is in Asian stocks. And that's because it's a huge industry over there, not only in China, but also Japan. Companies like Nintendo are still very big businesses. Also doing well out there today, Global Silver Miners ETF. This one's currently in my ETF portfolio. As many commodities had a very good week. Platinum pushing up another 2.8% today. And many international stock markets, South Africa breaking out to new highs. European financials have been on a tear. And what we've really seen this week is energy and oil ETFs start to pop up, potentially on geopolitical tensions. The Van Eyck Oil Services ETF getting increased volume here this week, closing near the highs. Another good performing ETF this year, the American Industrial Renaissance ETF, looking to benefit from the reshoring of manufacturing, as is the US Infrastructure Development ETF PAVE, looks to be forming a pretty solid base here that it could break out of. But one of the best performing funds this year has actually been the International Small Cap Value ETF, up about 40% year to date. The Russell 2000 is not even up 10%. So we've got a raging global bull market out there, especially in international small cap stocks. And here's a look at the 10 ETFs currently in my ETF portfolio. Finishing strong there today on another good week, up almost 10% for the month of September. And like I said, I'll be buying 10 ETFs next Wednesday as part of my new ETF Portfolio Service. And again, I just want to really thank all you guys that have joined me on my financial journey with the ETF portfolio. You're literally the ones that power this channel and my ability to bring you guys content every day. So I take my responsibility very seriously. I'm committed to running this ETF portfolio for many more years to come, and I'm super excited to kick it off on Wednesday. And I'll be sending out the first monthly report on Tuesday, letting you know what 10 ETFs I'll be buying the next day. And so I invite anybody else thinking about joining, now's your time to jump on board and not miss out. Click the link below this video and use coupon code ETF40 to lock in your permanent 40% discount today. That's all for this week on the Daily Market Review. Thanks for sticking with Click Capital. Have a relaxing weekend, and I'll see you back here again come Monday night. Cheers.